So it is official. The Fed just increased the interest rate by another 75 basis points, which basically means that we are right now sitting at the highest interest rate we've had since 2007, right before everything crashed. And the effect of this rapid increase in the interest rate have already shown itself within the economy. The housing market is in free fall, with home sales having fallen by 30%. Bloomberg reported a loss in stock value of $7.7 trillion within the second quarter alone. But the effects of what they're doing is also spreading to the rest of the world, as they're basically destabilizing other national currencies by increasing the value of each dollar. And if this continues, well, then experts are basically warning us that this will take us straight into the next global recession, in which what we've seen so far would only be the beginning. That is exactly why it is super important to talk about what the Fed is saying is going to happen within the next few months, and talk about how this is going to affect the real estate market and the stock market, but most importantly, how you can use this information to make money. So let's start by talking about what the Fed has done and why they did it. The reason why the Fed has increased the interest rate this much is to combat the extremely high inflation, with the belief that the higher the rates go, the more expensive it becomes to borrow money, and that should reduce the spending, which in return should reduce the inflation. The only problem is that no matter how much they've increased the interest rate, well, then nothing has happened with the inflation so far. An explanation as to why the inflation haven't decreased yet is that for these macroeconomic changes to appear in the economy, it takes a long time. And therefore many experts are predicting that the changes in the interest rate will only be visible in 2023, since there is this lag between when a change is made and when it appears in the economy. Well, then are very many experts actually now fearing that the interest rates have increased too much, and therefore is the next recession inevitable. Let's just take a look at what these changes already have done to the real estate market. But before I do so, then I want to say that making a video like this one takes a long time. So if you actually like today's video, then please press the like button and subscribe to my channel if you want to see more videos like this one in the future. With that being said, then let's start talking about the real estate market. When looking at the real estate market, we see that the mortgage rate have almost tripled since January this year, and the mortgage rate is now sitting at 7.2%. And as of today, we are seeing the highest mortgage rate since 2007, right before the housing market crashed. And as a result of this, the market is in free fall. New data has found that construction sales have declined by 10% in September alone. Economists are predicting a fall in the housing sale of 4%, but it is now down by 31%. This is definitely showing that the real estate market is suffering. And since they just increased the interest rate again, well, then could it actually become even worse? Since the high inflation is causing everything to increase in price, and the wages falling behind, it now means that the purchasing power has been reduced by $100,000, which essentially means that the market has nowhere to go but down. A really good indicator of where the housing market is going in the future is the mortgage demand. This is typically regarded as a really good forward-looking indicator of where the market is going, because the buyer always has to qualify for a mortgage before he can buy a house. And recently, the mortgage demand just hit the lowest level within the last 25 years. Overall, it is definitely safe to say that the real estate market has been hit really hard by the increases in the interest rate. And since they keep on doing it, well, then it could become even worse than it is today. But the real estate market is not the only market that is crashing, because right now the stock market is in free fall as well. So let's talk about that. In September, Bloomberg reported that the stock market is now down by $7.7 trillion, and all major indexes are now down by 20 to 25% year to date. And according to one of the world's largest banks, JP Morgan, well, then could the stock market easily fall by another 10 to 20%. The high interest rates combined with the high inflation is slowing the economy down. Consumers are not spending as much as they used to, and that has a negative impact on the earnings for companies, and that results in companies having to cut their costs to the bare minimum. When listed companies are reporting their revenue, they are also giving a guidance on what they think the future will look like. But right now there's a lot of companies that is changing this forecast of what the future will look like. And some companies have even said that they actually don't think they're going to make any profit in the last quarter in 2022. Companies are right now changing this future forecast at the fastest pace within the last 10 years. That is indicating a high uncertainty of what is going to happen in the future. But it is also indicating that the majority of companies think that the economy is going to slow down. Overall, it is safe to say that things are looking really bad for the stock market. But there is also a lot of things that are actually indicating that this could be a lot worse. Now I've talked a bit about the real estate market and the stock market, and now it is time to talk about how you can profit from this situation. Even though all I've talked about so far in the video sounds really bad, then an increase in the interest rate does also bring certain opportunities. And the first thing we have to talk about is savers. As the rate is increasing, banks are earning more on their deposits, and they are therefore able to give you more money for depositing your money in the bank. And many banks have in fact already started doing this. They are now offering between 2.5% to 3.5% interest rate on your deposits. These are rates we haven't seen within the last 15 years. So please take advantage of it. The bond market is also looking really interesting right now. Many US government bonds are paying 4.5% on all terms above 3 months, and other bonds are paying up to 6%. So if you have some money that you don't mind locking away temporarily, well then you're actually able to get almost the same return as you are in the S&P 500 index, but without taking any risk. And the third option, that is something that I'm actually personally doing, which is buying into the stock market when the prices are this low. I'm personally investing whatever I can into the stock market because I strongly believe that 10 years from now, the market will have recovered and reached all new time highs again. So for me, investing into the stock market, even though it might fall even further down, is definitely worth the risk. That was all I had in today's video. Thank you for watching the video, and if you actually liked the video, well then don't forget to press the like button below the video and subscribe to my channel if you want to see more videos like this one in the future. See you in the next one.